Many who trade the markets will be well aware of the old phrase, sell in May and go away. We've spoken about it before on this programme with our next guest, Ron William from RW Advisory, who joins us now with some more analysis on this. Ron, welcome.
Happy greetings.
When we last spoke to you, which was a couple of weeks before the Brexit vote, you were highlighting the seasonal trends and the event risk as well. And we were talking then about this old phrase, sell in May and go away. And you were highlighting June and September as the 2 months when we get a lot of volatility. Explain what's happened over the summer.
Yes, well, according to the studies that I've run, it's the end June period which tends to be the most volatile, and then thereafter September into October. And we did get that extreme volatility ahead of the Brexit vote on June 24th. But of course, what we did see thereafter is a new high, so a relief rally from oversold conditions into new high territory in most of the Western equity markets, particularly the US. Now, we're back at that second and final stage of the cycle, and this is why we're here today to discuss the most important fall crash cycle, which tends to fall around this time.
Well, let's have a look at that and bring in your first chart here, which is titled Peak Drawdown in Q3 during the latest cycle. Let's take a look at this in some more detail, because to the right we've got that recovery that we've seen in the markets in this last couple of months on from the June referendum, which did see markets down about 5%, didn't they?
Yes.
Since then we've seen in some markets record highs.
Yes, and that ties in with the midsummer rally, which is kind of the interruption period within this pattern, but it's from August onwards that we start to look for a top in the market. Now, it's important to highlight the fact that, as most people know, we've gone for about 40 plus days now without a 5% move. So extreme calm before a potential storm, certainly in terms of technical price patterns over extensions, but also the timing element. And we can see here that the equity market is still historically overstretched, breaking the 2008 record for the number of days without 20% correction. And more specifically, that's the price measure, but the timing here's a historical context of all the times that this fall crash cycle, which is an autumn period cycle, has taken place in the market. And the greatest examples have been the 2008 crisis move that we saw of about minus 34% during that period, and then in 2011 minus 17%. So these were the kind of the real historic examples of when this cycle worked best. But even thereafter, the cycle has worked almost year on year, but to a lesser extent in terms of price magnitude.
In the interim, we're getting these new highs, but that takes us even more away from the potential downside that the market could suffer from.
Well, it could do, but a lot of the signals that I'm looking at are suggesting that this is a weak signal that we have at the moment on the upside, and it might play into the greater fall kind of danger zone here, where we are pretty much picking potentially the high of the market. The risk-reward ratio has become very poor, and the risks are actually more to the downside than there are to the upside. So I do concur that there is a likelihood not only that we maintain this new high, but that we also might make even another marginal new high. But all of this will be temporary, limited, and highly risky for anyone looking to go into that long trade. And the better position would be on the downside, particularly ahead of some of the charts that we're about to look at. So this is a roadmap of this seasonal pattern that we've been discussing. So a lot of people talk about it in theory, but here it is in practice. And this is 100 years worth of average price performance of this seasonal pattern. And this is the autumn fall crash cycle pattern, not the sell in May. So this is the second and final stage of this drawdown. And what we see is it begins with a midsummer rally, which tends to happen in July. We've had that. That's the relief rally that happened post-Brexit, what some people are calling the Prime Minister May relief rally. Right. And we've make highs usually into the August period. Now, we have been flat for the whole period of August, so that has played out so far, although the jury's out whether this is the high. But what we are expecting, the growing probabilities are skewed for considerable volatility and drawdown risk in September, and more specifically the second half of September and early October. Now, this becomes even more important when you think of some of the event risk during that time, which some of your viewers might already be aware of. Well, first of all, we have the Fed meeting coming up on September 21st, 2021, where there's even more probability that the market's betting for a rate hike and what that might do to the market. Of course, we also have the Italian referendum, which has been deferred for now, but if that does take place any time into this cycle, that would add another element. And then the following slide actually talks more about the presidential risk as well. There is a false low that gets created in September, which usually acts as a kind of a sucker move for a lot of the traders, unfortunately. But the real low usually appears thereafter in October.
Okay, so that's that true low that you've got there. Let's go to chart number 3 because you talk about some of the event risks, and we've spoken about this before about the big event this year being the US presidential election, and you've overlaid this on this chart here.
Yes, well, I mean, all types of signals, be it technical or any other, require growing confluence or growing probability skewed in the same way. And so in this particular example, we're talking about cycles. So it's always best to look at a mix of cycles. And when the cycles are all skewed the same way, that's a pretty good move to bet on. And here we have a long-term, medium-term, and short-term cycles all pointing in the same direction. The only thing that I've missed out from this chart is the long-term cycle. That's the 10-year decennial cycle, which we've spoken about in previous interviews. But here we're looking at the 4-year cycle, the presidential cycle, and the 1-year cycle, the seasonal pattern that we've been discussing. Now, the 4-year cycle is measured in a different way according to my proxies. Instead of looking at the election year just as a plain vanilla measure, I actually look at the second term of a presidential election year as being more pertinent to this year, with Obama being in the second term. Previous examples have been, of course, Bush, Clinton, and others, which have yielded negative performance in the equity market. And that's because the presidents of that time, because it's their second term, they're seen as lame ducks. And consequentially, that creates a lot of lost ammunition in terms of policy movements and just general bearishness in the market in terms of sentiment. Now, this year is even more bearish because the divergence now in terms of asset inflation and contracting economic and business conditions are still there. But also, even the selection that we have this year is that much more polarized and that much more ominous between Clinton and Trump. And then third to that is the fact that we have additional event risks like the FOMC meeting, which I mentioned coming in September, and the potential risk of an Italian referendum thereafter.
Up until now, you've been putting together all sorts of statistics and data to bring together to illustrate this in chart movements. Let's overlay this now with an index, because I know you've brought along the Dow Jones Industrial Average, haven't you? To give us an example, if we can get this last chart up to show us where we are in terms of some of the levels. Explain what's going on here. We know all well about the all-time high that we've had recently for not just the Dow, the S&P and the Nasdaq as well, and some other global indices. But this is where we are on the Dow.
Yeah, so it's important to talk in terms of price levels, especially for a lot of traders that are looking to position themselves. So certainly the all-time high is going to be the key level at 18,668 on the Dow. And of course, we can look at related levels on the S&P or the Nasdaq. There is still a growing chance of another new high above that price level. But again, just to clarify, I would deem that as a temporary limited move, which would potentially play into the greater fall theory danger zone, as I like to call it, where the risks are much higher. And the risks on the downside would definitely be triggered if we get a confirmed move below 18,350, and that's the all-time high on the Dow and again on any other market that we're looking at. Now, if we get that, the key levels beyond that would be the level I've drawn in there at 17,740, which is a value zone, which I've drawn using a unique tool, the probability distribution tool which I use. And basically the levels beyond that, these are all support levels, but the long and short of it is, if we get a trigger below 18,350, that does trigger a potential 20% drop in the market, which is basically the equivalent of the move down to the 2016 lows. That's what it would equate to. And we haven't seen that since the 2008 crisis. So this would be a longer weighted healthy move. And if we do get that, of course, we could then follow up thereafter.
Yeah. Do we view this as a good and reliable bottom to the market if that does go down that far, or is it just a question of support until the next leg lower? Is there any indication to give us an idea that this market could fall even further?
Well, a good question, and in previous discussions we've had the larger cycles have the answers to this question, and that's the decennial cycle specifically, which is the 10-year cycle, and that suggests that we're not only bearish this year, but next year. So it'll be a staged process of bearish downside from here on into 2017. So I think we start to get the strength of the downside kick off now, particularly with all the event risk that we have this year, and play out into next year. So it will be a staged process between now and then.
Okay, so we'll get you back after the presidential elections in November, and we'll regroup and work out where we are on the map, and we'll see where you are from there.
Look forward to it. Thank you.
Ron, thank you very much indeed. That's Ron William taking us through some of his charts, updating us on some of his charts he's spoken to us about before. He's with us there from RW Advisory.